That's where palladium is used primarily, is in catalytic converters. But here's the kicker: is hybrids actually use more palladium than even an internal combustion engine, like 10 to 15% more. So that's where I think the market's way off. So that's why I think palladium has so much upside. Now,
since 2014, CapEx for energy companies is lagging by some estimates as much as $3 trillion for multiple reasons, including the big one, ESG. In other words, there hasn't been nearly enough good old-fashioned investments in coal, gas, uranium, oil, and metals exploration and production, especially in the North America area in the last decade. And over the same time frame, global population has grown by almost 1 billion people. Plus, there's millions that need to move up the economic ladder in the Asian region. What is the impact of this $3 trillion investment shortfall on energy and supply at a time when energy needs are clearly exploding?
couldn't agree more. I think you summarized it very well. I think what's maybe not appreciated, and this was actually something I stumbled across here recently, is the CapEx starvation that you described in the energy complex is actually worse than when we look at the raw numbers. What it doesn't tell us is how much of the current capital spending in energy is going to the LNG facility build out on the Gulf Coast of America, which is truly one of the great miracles of really energy history. We were supposed to continue to be the world's largest importer of natural gas. 15 years later, we're the world's largest exporter. So some of these facilities were built to bring in natural gas, were converted so they can be export facilities. And then they're building a lot more. So you're looking at something like a 20 billion cubic feet a day increase in exports by 2030. And to put that in perspective, that's almost 20% of U.S. production of natural gas. So it's a really big number. And then the other thing that you've got is AI, which is increased AI data centers, which are electricity hogs. And frankly, they don't really want to run those on intermittent power sources. So natural gas is a really logical, but that's straying away from this LNG thing, liquefied natural gas. So that's where almost half of the capital spending that's gone into the energy area has gone over the last 5 years in particular. So my point is that the traditional oil and gas exploration activities have been even more underfunded than it looks superficially.
Wow. So that will have detrimental effects at some point down the road, right?
I think it has to. And yesterday was a fascinating day beyond the inflation numbers and the Fed presser with the IEA making their statement that there's going to be a staggering glut of oil by 2030. And it's got tremendous amount of press. And I think they're doing the world again, as they have so many times in recent years, a disservice, because that's just going to make people reluctant to invest in the energy complex. It's going to make producers reluctant to drill. The drilling rig count is already down a lot. And what's also another one that's kind of off the radar realities is that the reason we've been able to keep production where we have, despite this falling rig count, is because of something called drilled but uncompleted wells, DUCs. And almost never do you hear anybody talk about this. And so what happened during COVID is there were a lot of wells that had been drilled, but because of the price collapse, the producers didn't complete them. So the analogy I've used, it's like if you're a home builder and you had all these communities that were, homes were half built, whatever happened, there was a seizure, and this actually did happen with home building briefly. So then they just stopped. And then once things picked up, then what do? Do you go out and build brand new houses, or do you complete the ones that were half done? Well, first you complete the ones that were half done. Now in the oil and gas production area, especially the oil, those things have been drawn down to almost nothing. Those drilled but uncompleted. So now you're going to have to find new wells, and that's not easy. It's tough it's easy to find them. I shouldn't say that, but it's hard to maintain enough new production when you're dealing with shales. Would imagine you've got astute viewers, so they probably realize that the nice thing about shales, you almost never have a dry hole. The bad thing is the decline rate's very rapid. It's about 40% per year in the first 2 years, and they kind of flatten out. but it's like this constant treadmill that, spins at a very high speed. So if you're not out there aggressively finding new oil, at some point you're going to see the basins actually decline. And actually, every U.S. shale basin except for the Permian is declining. And now the Permian looks like it's going to decline this year or maybe next year, but it's certainly the production growth has flattened. Now we're basically, producing about what we did pre-COVID. It went way down and then we've come back, but it's essentially flat over the last 4.5 years. And yet the IEA is out there telling everybody, oh, there's going to be this tremendous surge of U.S. production. I think they're dead wrong. And by the way, they've been dead wrong for years, even decades. They have grossly underestimated demand. They have grossly overestimated supply. I don't know why anybody listens to them, and actually Congress is now getting on their case and pointing out that a lot of this misinformation that they're putting out is actually hurting U.S. energy security. And I think that's exactly right. I don't know I think they do a lot of this for political reasons. And actually I heard Gunlock talking about this yesterday, saying that he thinks that oil prices are being artificially suppressed prior to November. And this is a great example of how they could do that.
So you see the shale basins declining, and you see that as an issue moving forward, and you see that in contradiction to what the IAEA is saying, that there's going to be a glut of oil over the next 5-6 years.
Absolutely. And I really want to emphasize oil versus natural gas. Natural gas decline rates are slower, but it even looks like the Marcellus is topping out. So, but just to be clear, this is not a Dave opinion. The reality is all the U.S. shales are in decline, production decline, except for the Permian. Now, it's debatable whether the Permian is flattening out. It's starting to head down. The people at Gehring and Rosenzweig are very, very bright. They think it's probably going to be, this year, next year, that the Permian starts to erode. It is an exceptional basin. So I do want to point that out. I mean, they call it the layer cake because there's just so many levels of pay zones, and you've got a lot of brilliant people down there that are very entrepreneurial. They're the ones that created this amazing miracle that we take for granted in this country. Mm-hmm. So I don't want to sound too gloomy there, but I think even with the Permian, they'll be doing a great job just to stay flat, much less grow like the IEA says.
Let's head back over to uranium for a moment, David. Uranium's been in the news over the last year, just like you said, doubled in price. Politically, the G7 nations are getting behind it. Reactor demand is projected to grow 40% by 2030. U.S. Energy Secretary Jennifer Granholm recently said that in order to meet our energy goals by 2050, the U.S. has to triple nuclear output. There seems to be a powerful nuclear energy renaissance playing out right before our very eyes. Even companies such as Microsoft and Amazon have embraced nuclear to meet the massive energy needs that their artificial intelligence data centers require. How large of a role, realistically, do you see nuclear power having in terms of meeting the energy needs over the next 10 to 20 years? What role do you see SMRs playing? Will there be a place for the reutilization of spent nuclear fuel? And how are you positioning for what's coming?
Well, okay, let me answer that last one first, because unlike with energy, it's really tricky to find attractive uranium equities. The Cameco is kind of the obvious go-to, and I'd say buy it anytime it gets hammered, which it has had a few big dips the last couple of years. But pretty much after that, it's all these very niche-y, development phase companies, and some of them have great stories, but they're years from profitability. They're years from production. And that's really, I think, the bull case for uranium. It's just going to take so long to get these mines into production. And then you got Kazakhstan, which, that's the 800-pound gorilla in the uranium production area. That's basically the Saudi Arabia of uranium. And they have just shocked the world here recently by saying that their production, which was supposed to go up, is actually going down. Mm-hmm. And I look at the supply problems, and I look at this rapidly growing demand outside of the United States, I might add. Although even in the United States, you can say, well, there's some restarts happening. That's probably the most bullish thing you can say, is we are restarting some of these previously mothballed nuclear facilities, but not enough. And we don't have any new major nuclear plants, these 1,000 megawatt, gigawatt type of light water reactor plants. We don't have a single one that's really on the drawing board. We have the two Vogel ones down in Georgia that were completed after, decades and way over, like triple the original cost or double the original cost, not triple. But in terms of triple, where there is a triple, is it costs us 3 times as much to build a major light water reactor plant than China does. So
Yeah.
we have none under development right now in the United States. Around the world, there are over 60 major nuclear reactors in the construction or the design phase.
I think
So
there's over
where's that
300 in
uranium going to come
planning.
from? Pardon me?
I think there's over 300 in planning.
Could be. I guess
Yeah.
I'm just looking at the ones that are close to production. China's got 20. So how's the U.S. going to do what Jennifer Granholm said? How are you going to possibly triple that when you don't even have anything in the wings? Now, you brought up SMRs, small modular reactors. I'm very bullish on those, though. There's just been all disappointment after disappointment, including with TerraPower, NuScale, and they've spent hundreds of millions of dollars. Really don't have anything to show for it. Is I think I mentioned this to you in an email that I am an investor and a supporter of a company called Micronuclear, which is a bunch of, and this is non-public, nobody can invest in it unless you contact them, and it's very high risk. They too have to get NRC approval. They've got a very clever plan to try to do that, but that's the big problem. I mean, I half jokingly say that the NRC should have a in front of it for Anti-Nuclear Regulatory Commission. They are just so obstructionist. It's almost
so the supply picture that you're painting, those who are paying attention to the uranium space, they've heard this before. Do you see a massive price spike coming?
We've had it, but then we've had a sharp correction, and I think that's typical. But I think there's another up leg coming, and I think this sell-off in uranium is a buying opportunity. So just to be clear, yes, I think there's going to be tremendous demand for uranium, but not so much from the U.S. just because of these impediments, at least until a company like Micronuclear can break the code, if they can. And then you can get thousands of these SMRs in place. And you brought up this earlier, which is, I know that's one of their goals, and I'm actually supporting a consortium in the UK where there has been quite a bit of work done in terms of recycling spent nuclear fuel. It's more expensive, but it's a huge problem right now. Most of this nuclear fuel isn't put in Yucca Mountain where it was supposed to be. It's at 3 Mile Island, or it's at the Niagara Point, wherever, Mohawk, all these different nuclear, Diablo Canyon. They have these secured areas, so that's where they feel like they should store the fuel. But it's not an ideal solution. And I think the view is, one of my nuclear friends points this out. This is a very important point, that we've always looked at that as a liability, that huge reservoir of spent nuclear fuel. And his point is, it's an asset. And their SMR, which is actually a molten salt reactor, can reuse the spent nuclear fuel. If governments get behind that and they start directing some of this money, that these trillions that they throw at all this nutty stuff, and do something like that, I mean, that could really take the nuclear renaissance to the next stage.
That's awesome. It'll be interesting to see how that plays out. As the U.S. is running the fiscal dominance playbook and experiencing these massive deficits, the rest of the world is realizing that if they continue to park their reserves in treasury debt, they're going to get paid back in depreciated dollars over time, making their reserves worth less. So they have instead been big buyers of gold, just like you pointed out before. That's in order to retain their purchasing power of their reserves. Also, nobody is a liability factor there. In fact, the central banks, they bought more gold over the last 3 to 4 years than any other time in recent history. Do you anticipate this trend continuing over the long term? Will gold's role expand, in your opinion, on the global financial stage? And what, if anything, will that mean for the gold price?
I think it will trend irregularly higher. Like with uranium, I think there's going to be big sell-offs and then huge rallies. It's going to be a stair-step type of thing. So that's why you get back to my kind of core advice for people that are in commodities. Just realize they are volatile. And when everybody loves them, you might want to be taking some profits. Now, I will say with gold, even though it's had a massive breakout here recently, which in our way of looking at things is very bullish, when you take out a multi-year resistance level, or in this case, go to an all-time new high, that's a great signal. And I think what's encouraging for gold is that Western investors, as we said earlier, are kind of apathetic. So you aren't seeing that kind of euphoria that typically marks a major top. So I think that's encouraging. I also think it's encouraging gold's pullback has been fairly muted, and but still, if it were to go to 3,000, I would expect that there would be pretty sharp correction at some point. But ultimately, does it go to 10,000? I think probably. Now, don't ask me how long ultimately is, but I do think gold is going to go substantially higher. I think where the real money to be made is with, say, a Newmont, which, by the way, actually had a positive surprise for a change. I think these guys they're following finally, belatedly, the big oil playbook, where they're realizing that trying to develop these new mines is very tough. Don't force it. If you get a great prospect, that's one thing, but otherwise, buy your own stock back, pay down debt, generate a lot of free cash flow, and I think they finally got that memo.
So over the last few months, silver's broken through some key resistance levels. The 26 to 30 zone was like a minefield for it, and it kind of busted through several in there. It went as high as 32.50. It's come back down. It's been hovering around 30. I think today it's down closer to 29 or so. But silver has many widely used industrial applications, from solar to everything electrical, military, water purification. The list is so long. It's also historically been a monetary metal, even though it has not been that in the United States in quite some time. But with the declining purchasing power of the dollar, due to the government's massive fiscal spending, it seems like the metals are both coming back into people's minds and thoughts potentially in this case. What's your silver thesis moving forward?
Yeah, I like it. It is very volatile, more so than gold, but it too has had a major breakout. And a lot of times this was true with stocks too. When they break out, oftentimes they correct hard, and people say, "Oh, that was a false breakout." And sometimes there are false breakouts, to be fair, but not very often. And I don't think with commodities as essential as gold and silver, and particularly when there's such a supportive backdrop. And you're exactly right. I mean, if solar panels are going to proliferate, which I think they will, I think I would bet on that more than EVs. Again, I think EVs are going to really flatten out. Maybe they could even decline at some point. Their growth rate could actually turn negative. Maybe actually contract overall, but I think hybrids are just going to go nuts for a whole variety of reasons, which we maybe don't have time to go into. But solar panels, they use a lot of silver, and that's a demand factor that was not there until last 5 to 10 years, and of course it's grown drastically over that period of time. So yes, I like silver, but again, I would try to buy it on weakness. We actually have trimmed a little bit because we bought it quite a bit cheaper, and so but. Again, we try to have a core position, and if something doubles, then sell 20 or 30% of your position. You still get a big commitment, especially relative to the index. Just as one point is that if you look at the S&P, these commodities are minuscule. There's almost no. So if you're heavily overweight, as we are, these real asset types of companies, you're taking huge benchmark risk. On the other hand, you've also got the potential for a huge benchmark reward. And we've seen that pretty much this decade. I think we're going to see a lot more of it between now and the end of the decade.
Yeah, I'd have to agree with that. So, David, you were talking about EVs growth slowdown, even maybe turning negative, giving way to the hybrids that you believe are going to explode, and others do share that similar sentiment. Hybrids use more platinum. Do you have a strong platinum thesis?
Well, actually, it's palladium. So platinum is.
I'm sorry, that's what I meant.
Yeah, platinum has demand from diesel, and I know some people like platinum, and I've bet a little money on it lately, and I think it's fine. But I think the real story is palladium, because the reason palladium is sold off so hard, and it's basically down 2/3 from where it was even before the invasion of Ukraine. Now, when Russia attacked Ukraine, palladium went nuts again, basically made a double top. But it's been absolutely annihilated since then. And it's because the belief, and it's not just a belief, it's true, that EVs don't need palladium. They don't have catalytic converters. And that's where palladium is used primarily, is in catalytic converters. But here's the kicker is hybrids actually use more palladium than even an internal combustion engine, like 10 to 15% more. So that's where I think the market's way off. So that's why I think palladium has so much upside. Now, the equities, again, it's tough to play the equities. There's one in South Africa that's really cheap, but it's got all kinds of hair on it. But I think palladium itself, I own, full disclosure, I own a decent amount personally.
Yeah, I appreciate that, and I appreciate the correction. So gold and silver mining companies, you were mentioning earlier that you had a good position back in 2020, and then took some profits off the table, but left a core position, and they've kind of languished for several years until they've perked up a little bit here in the last couple of months. What's your outlook on the gold and silver mining sector over the next 1 to 2 years?
Up. I'd say up. They've run quite a bit lately, as you pointed out, though they've pulled back somewhat. So once again, we took a little bit of profits into the run up. Some have done exceptionally well, like Alamos, AGI. Not all these gold miners have been inept. AEM, Agnico Eagle is another really superb performer and executor. But I obviously have a penchant, being a contrarian, value-oriented guy, towards the laggards, and that's why I'm intrigued by, say, a Newmont, which has been just such a dud for 15 years. And I think it ran to 80 back a couple of years ago, and now it's trading in the low 40s. And yet they're now starting to report some very strong earnings. And once those higher gold prices filter through, it could really catch analysts by surprise.
Yeah, that's outstanding. So if you had
I hope so.
If you had to process through 2 to 3 trends that you're watching or looking for over the next few years, what would you say those top trends would look like?
Well, I guess I would just go back to something that I learned from my good friend Grant Williams. Actually, he's British, so he says Grant Williams. And he, in turn, got it from Tony Deaton. I don't know if you've ever interviewed Tony. He'd probably be a great one if you could get him on, but he's a famous Swiss investor, kind of a Felix Zulauf type of individual. And his view is you want to invest in scarcity. And he totally ignores what the S&P is doing. But so he naturally tends to gravitate towards things that central banks can't print. And that's, I guess, what I would say is if you can be buying things that actually benefit from central bank currency debasement, that's probably going to be a nice wind at your back for a number of years. Maybe that's just kind of stating the obvious. I don't know. I would say that this isn't a long-term trend. This is a short-term trend. As far as playing bond rallies, I do think we started to get more positive on bonds here recently, on even treasuries, just on a tactical basis, because if we are going to get a major slowdown come recession, bonds will likely go down in yield. I think, again, they're to play short-term, not to, I guess the way to say it is to rent them, not buy them. So it's not like it was for 40 years where, you could be a bond bull. I do believe we're in a long-term. So to answer your question better, I'd say you could be a bond bear long-term, even though with the short-term qualification. So you could actually outright short bonds, if you got the 10-year down to 350, something like that. And I've done a lot of personal shorting of bonds in recent years, and it's actually been very good to me. I'm not right now, other than the French government bond, but and JGBs, because I do think Japanese government bonds are going to go much higher in yield. That's a pretty interesting story too. So that's another, what I would say, long-term trend, is to bet on much higher yields in Japan. I'd bet on a big rally in the yen. The yen is extremely depressed, so I think those are a couple of things that you could play long-term. It's probably easier for people that want to play the long yen. You can do that easily with an ETF, a little more sophisticated to short JGBs. But other than that, I don't know that I've got any great pearls of wisdom. I guess I believe that in the U.S. stock market, you're going to see a normalization between the laggards and the leaders. That when I was talking earlier about how far behind the equally weighted S&P is versus the cap weighted, that's going to normalize at some point. It looks a lot like it did in late 1999, early 2000. Don't ask me when that's going to happen, because there's just so much momentum right now with these AI plays, but it seems to me getting pretty overdone.
This has been a wonderful conversation with you, David. And before we wrap up here and I ask you the final question, I just want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals, miners, and all the expert interviews, just like this one that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with David as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video. David, in wrapping up our discussion, I want to reference Ray Dalio. He recommends a 10 to 15% gold overlay on the portfolio. What do you recommend in terms of gold ownership for the average investor in terms of allocation?
Yeah, I think that's about right if you'd include the miners. Again, I think that's a more attractive area than even bullion, but I know a lot of people just don't want to buy miners, so 10 to 15% of bullion, that's fine. And there's some pretty easy ways to do it where you can get physical. I'd be careful about, which vehicle do you use, because there's a lot of suspicions, I think, well grounded in some of these ETFs that they don't actually have the gold that they're committed to. But the Sprott folks do a great job in that regard. So I basically agree with what he's saying, and who's to argue with Ray Dalio? And he also is very much in line with me that we've got this very severe societal fracturing going on, and kind of related to everything. I didn't bring this up earlier, but I think it's very supportive of this concept. Is that I believe the Neil Howe thesis that we are in the fourth turning, which is basically this would be the third mega crisis of our American history, the last one being the Great Depression, World War II. And typically precious metals do really well in fourth turnings because they tend to be inflationary, and I think that's how this one's already turning out.
Yeah, I appreciate that. I appreciate your wisdom and your perspective and your level-headedness and your insights. It's been amazing. Thank you for coming on to the Metals and Miners podcast, for being so generous with your time and your analysis and your ideas. Would you please share with the viewers any final thoughts that you want to leave with those tuning in, where they could learn more about your work and how they can connect with you?
Well, we're easy to find on Substack. So it's haymaker.substack, and we just Haymaker Substack, you'll find us. And we do put out two newsletters a week. One is more with investment ideas. We mostly just highlight, and we can be a little bit more aggressive with asset classes versus individual names. And then we also put out a macro piece, oftentimes with a very prominent guest author, such as my great friend and partner, Louis Gove, who I know you talked to here recently, Grant Williams, Daniel DiMartino Booth, Jesse Felder. I mean, some really bright people are nice enough. Kevin Muir, who's a big gold bug or gold believer. So yes, please go there. And a fair amount of the content's free. We do have a paywall for some of our more critical proprietary content. So thanks for bringing that up. I usually forget to do that.
Yeah, no problem. I will put all of the URLs and information up there. Are you also on Twitter?
X or whatever the hell it is now.
Yeah. I'll find you. Yeah, I'll find you. I'll put that in. I'll put that information up there. Everybody, you really do need to follow David, get on his Substack and pay attention to everything he's sharing. He's a wealth of knowledge and you don't want to miss it. David, I look forward to having you back on sometime soon. Thank you for being here with us, and everybody else, thank you for watching.
Thank you.
I just want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals, miners, and all the expert interviews, just like this one that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us.